Good afternoon, ladies and gentlemen. We are 2 days away from what is the most important national event for stock markets, the annual budget, which will be presented on Saturday by Finance Minister Nirmala Sitharaman. This budget comes at a time when 2025 has been a challenging start, to say the least, with macro deteriorating over the last 6 months or so. We have a rupee at record low. Forex reserves are almost dwindling. Growth has slowed down, and there are challenges globally, including this tariff war that is coming from the United States. This is as good a time as any to speak to Upasana Chachra. She's the Indian economist at Morgan Stanley and is joining us to discuss what could be the possibly guardrails on the budget and what is most likely the outcome 48 hours from now. A very good afternoon to you, Upasana, and a very warm welcome. Let's look at the budget from the point of view of a macro positioning. What are the 2 or 3 major events that you expect this document will unveil for both macro and stock market investors?
Thank you for having me here, and a good afternoon to you and your viewers. So on the budget, of course, there's a lot of hopes on it, given as you rightly summarized that the macro environment has been challenging to say the least in the last 6 months. And I think the budget will, as always, be dissected on its policies to support growth and also how it stacks up to preserve macro stability, i.e., on the inflation and external stability metrics. So I think from a very broad top-down perspective, the 3 key things that we think we should probably look out for in the budget would be one, needless to say, the fiscal math and the budget accounts. After all, budget is a statement of accounts, and we need to see what the fiscal deficit that the government pegs for fiscal 26, and also where they end fiscal 25, given we're sort of doing better than expected in terms of the fiscal deficit number. So that's going to be one. Second is a bit more on how the government is planning to spend the money. Expenditure growth on the capex side has been a key theme over the last few years, and that has been a bit of a dampener in this year, where capex spending has been slower than anticipated. And in that context, I think there are there's a lot of focus on how much capex growth are we likely to see, and what sort of number in terms of versus the INR 11 trillion number are we going to see for the budget for fiscal 26 that the central government sets itself for. And lastly, of course, there will be some as always, measures on a sector specific basis. We could, see more nuances around policy initiatives, either from a tax change perspective across indirect taxes, or some tweaks on direct taxes, and also any other sector specific measures that they come up with related to, say, PLI or other support for supporting the domestic industrial base.
Okay. Upasana, let's address the elephant in the room. And for everybody in India, as far as the budget is concerned, there are 2 main themes that they think of. Are we going to get a cut in personal taxation? Do you think there is room enough for the finance minister to sort of work her math and give us some relief when it comes to personal income tax? As all of us know, the last 1 year has been very, very problematic for the middle class. A lot of money has gone into the stock market, which now seems to be in pain. Disposable incomes have come down, salaries have been stagnating, and of course, jobs are few and far between. So, is this a time to look forward to a cut in income tax?
I think, yes, this backdrop for the budget against sort of urban consumption slowdown, and again, as you summarize, wage growth being tepid for the organized sector, inflation not being very supportive again, so purchasing power has come down, definitely has created the case for some form of relief for middle income taxpayers. And it's not just this budget. I think mostly in across, as you again mentioned, that's one thing that's always common, and you sort of look forward to, is there going to be any form of direct tax relief, especially on the personal income tax side. Our view is that we don't rule it out, so there can be some tweaks on the direct tax side, or rationalization that we can say for the low income taxpayers. But I think at the overall macro driver perspective, we don't think that will create a meaningful change, primarily because we still think that the government will hold on to the path of fiscal deficit consolidation. So if they're going to reduce the deficit, even say if it's lower by 30, 40 basis points versus fiscal 25, the multiplier effect, or there's no as such change in fiscal policy stance that will change your drivers from a growth perspective at the macro level. So yes, there can be some relief at the very low income taxpayers slab level, and probably some consumption drivers for very sector specific FMCG sort of categories could benefit if that were to come through. But I think at the same time, we don't pencil that in to create any major change in a macro growth outlook from a growth drivers perspective.
What would be your estimate for the fiscal deficit as a percentage of GDP for the next year, which the government is likely to talk about?
So fiscal deficit, I think first I'll mention for fiscal 25, since fiscal 25 numbers are likely to be better than what the government is budgeting. So the target for this current year is 4.9% of GDP. We think that they ended better than that at say 4.8% of GDP, and this is baking in an assumption that spending will pick up, especially on capex side for the remaining part of the year. So if it were not to come through, then you can probably even see a better number than 4.8. So the starting point is favorable. Now, if you were to juxtapose that versus what we know from a medium-term consolidation path that the finance minister has sort of talked about in earlier budgets, they want to peg the deficit to around 4.5% of GDP for fiscal 26. So that's what we are taking. We are not going aggressive on the deficit consolidation path. We think given where the growth backdrop is, probably a slower pace fiscal consolidation or a gradual consolidation in the deficit targets is actually going to be beneficial. It will give the government the regal room to continue to support growth through spending, and at the same time adhere to its fiscal consolidation path. So our number for fiscal 26 is at 4.5% of GDP.
Okay. Upasana, the most trickier part that we are now facing is that over the last 6-8 months, the government put a handbrake on its own spending, and the private sector never held the baton at all. And we are now at a juncture where this slowdown is apparent to everybody. What is your own estimate for government expenditure in the coming year? And how do you see it over sectors? Which are the 2 or 3 main themes where this money is likely to be spent?
So I think on the spending side, the problem for this year has been lower than expected government spending, which probably was due to reasons like elections and then the long tail of the monsoon and erratic nature of rainfall, which sort of held back the spending, especially on the capex side, and that's where we are seeing the large undershoot. We do think that for going into fiscal 26, most of these factors, especially from a political landscape perspective, are behind us. Fiscal 26 is going to be a more cleaner year from their lesser political events. And we would probably then be seeing a more streamlined way of spending emerge, probably towards the fag end of from fiscal 25 itself. So our assumption on government spending is, and I'll break it into probably revenue and capex expenditure. For capex expenditure to grow around mid-teens, so we are budgeting about 15% growth. This will peg the number to around INR 11.2 trillion for the government's capex budget for fiscal 26. It will not look very exciting versus the 11.1 trillion that has been budgeted for this year, but we think this will be a realistic number given you end fiscal 25 at a lower number, so the growth rate should also be realistic. Our assumption is therefore like mid-teens for capex spending. We would expect that within this capex spending, more focus would be on the infra-related sectors, as has been the case till now. So industrial and infra-related like roads, rails, ports, defense, etc., should see spending growth probably in line or around these levels. That's what we are expecting, and that should then benefit some of the other sectors, related sectors like cement, steel, housing, etc., as well, which is because the allocation sees higher sort of growth and like robust levels of spending targets. On the revenue expenditure side, we expect it to be sort of similar to what it would be for last year. We don't expect revenue spending to see any meaningful change, and therefore, in our view, there's not going to be any change in narrative from the government side that we are shifting focus and spending more on the revenue side or increasing subsidies or transfers to households, either because you're worried on growth or generally to support consumption. I don't think that's going to be the case. We think the playbook remains as what we've seen in the past, where their focus will be on capex and capex to create more sustainable growth and then more job creation, which then keeps the growth trajectory supported.
Okay. Upasna, if I may, I'll ask you a very basic question. Are we in a structural slowdown or a cyclical one? Is there is there a light at the end of the tunnel, and how long is this tunnel?
No, surely it's a cyclical slowdown. It's not really a protracted one as well. So I think if you were to look at it from just a GDP growth perspective and GDP numbers, so September was at 5.4%, and we can safely assume that December quarter will be better than that. RBI has now cast estimate that is at 6.2%. So I think you probably look at high frequency data as well. Yes, it's recovering, probably not at the same speed or quantum as probably we would have liked. So it's still lower than the six half type of levels that we were estimating it to be, and therefore we see downside risk to our estimate of 6.5 for GDP growth for December quarter. But nevertheless, it will be better than 5.4. So I think the worst is behind us. It's that the pace of recovery is a little slower than anticipated, and it's not as broad based. And I think that is probably where the government spending and the policy support from the monetary policy side will also be critical. And it's good news that we are seeing that already happen. On the monetary policy side, some pivots are already taking place. And therefore, the cyclical slowdown will start reversing in due course. And you will see the light at the end of the tunnel sooner rather than later. So we do think, in short, it's a cyclical slowdown, and there are already some policy actions being taken up which will address this, and therefore you'll see the economy mending sooner than later.
Pasna, this is music to the ears of a lot of mutual fund investors and those in the small cap and the mid cap space who came into the market in the last 6 months, 1 year. That this is just probably a cyclical one and it's about to end soon. Okay, you've given us your estimate of the fiscal deficit. In one line, could you mention what is the expenditure number that you're looking at from the government side and the borrowing number?
So expenditure number, as I mentioned, we are looking at growth to be around 14-15% on capex.
Okay.
Revenue expenditure to be lower than nominal GDP growth. So blended number would be say for revenue and capex together to be around say nominal GDP growth of 10 odd percent. So as such, fiscal deficit expansion on the expenditure side is not anticipated because revenue expenditure will still be sort of moderate to lower than nominal GDP. Capex should continue to support growth. On the borrowing side, our assumption is of gross borrowing to be around 14.5 trillion. This could be lower if the government were to do say more switches or buybacks and also use the more of the GST cess quantum that is left for buyback for redemptions, which we have assumed a little bit. But the number could be better probably if they were to be on the higher side. But net, the borrowing number on the gross borrowing side may be a little higher as of now, what we think, versus last year because of the higher redemptions. Net borrowing number, though, still coming off. So I think from a demand supply perspective, it still remains supportive of bond yields.
Okay, fine. Now, is the worst behind for the rupee, or we are in for a smacking in 2025? 2024, the Reserve Bank of India spent $60 billion to, sort of keep this myth of a strong rupee with us. Maybe that was the election year, we let it by. But for 2025, what's the real exchange rate that you're putting in?
Yeah, I think a lot has to do with how the dollar behaves, and that's how this trade is like likely to play out. Because what has happening to the rupee is less to do with the domestic fundamentals, and more to do with the how the dollar has been gaining strength.
Yeah.
Because underlying, there's no problem with macro stability. Inflation is tracking lower and expected to moderate. Current account deficit is pretty range bound, 1 to at max 1.5% of GDP. Yes, there's been a problem to some extent on capital flows because of FII capital outflows, some amount of dip in net FDI. But that is again also a reflection of the dollar trade. I think in our view now, if you just think about the rupee and stay and from the current standpoint, the rupee on a real effective exchange rate basis is a bit overvalued. It is about 1.5% above mean plus one standard deviation. So, it's even above that band. And in that context, I think if we were to say that even if dollar doesn't gain further, probably a slow paced depreciation is required for the rupee to align to the mean plus one standard deviation sort of at least band. And that would also be healthy because that would ensure that you're not persisting with an overvalued currency, which from a macro perspective can then create risks of imbalances in the future. So I think some amount of rupee depreciation is fine and it's par for the course. And in the broader context, I think we can use the exchange rate to help manage some of these external factors and volatility that comes through, especially given there is still a considerable amount of FX reserves as war chest that the RBI has to come and intervene and defend as and when required. But I would say that there would be no need to ensure that rupee sticks to a certain level in this environment where dollar could probably still again gain strength.
Okay. We are at 86.51 today. Uh, December 2025, what would be your guesstimate?
So our FX strategy team actually does this. It's not my call, and we don't have a very, very updated number on this, given how the
Okay.
dollar has been behaving. But if I have to just give in my guesstimate, I think probably if the dollar is not gaining too much, then probably some slow-paced depreciation of 1 to 1.5% should be
Fair
par for
point.
the.
Fair point. Upasna, a last couple of questions. Uh, 2024 half was the year when Indian bonds started to appear regularly in global bond portfolios. How do you think has that experience been? And what are the inflows that you are expecting in 2025?
Yeah, I think the start of the bond index inclusion saw meaningful inflows, and actually it started preceding even the bond index inclusion. So the announcement when it happened, some amount of passive flows started coming through at that time itself. Of course, the last few months have been lackluster in terms of flows. We have also seen periods of outflows. Going forward, we think that again, unfortunately, we are going to be stuck to how the dollar behaves, because that will have a bearing on how the whole capital flows to the EM class get allocated, and that I think is where the problem for India is as well. So again, it's not a problem I think that is India centric, wherein there's some issue with either the inflation dynamics or the current account deficit dynamics, and therefore India is seeing outflows. But of course, just in terms of the attractiveness of the US asset class as well, which is creating these issues in terms of expected rate of returns. But we do think that eventually, as the dollar probably settles, and the US 10-year probably also pivots a bit, capital inflows towards the Indian debt market should resume. I think there is a period of volatility and adjustment probably in the near term, but probably as we get more clarity from the US administration on its policies as well, and as the dust settles, we should revert to a situation where we continue to start seeing some inflows coming back. The index inclusion per se, the weight increase is going to happen up until March or April at least, and that is one supportive factor for passive flows to come through. And if we dollar is well behaved, probably you start seeing inflows rather than outflows or sort of zero flow numbers.
Upasna, a well behaved dollar with Mr. Trump in charge is almost asking for the moon. Nevertheless, my final question to you is, what do you not want to see in the budget? This is against the backdrop of these populist schemes that are winning elections for politicians, and the total expense on the balance sheet is somewhere like 2 lakh crores and growing. How do you see that as something that might be a spanner in the wheel when it comes to India's glowing macro, relatively glowing macro with the rest of the world?
No, you're very right. I think the state level fiscal profligacy is a risk at the margin. It's something that we are also closely watching. It is gaining, it is sort of becoming more and more spread across states. It's not just a particular type of states which are announcing these schemes. More and more states are using that template, and it's a risk at the state level. At the central government level, what, as you may ask, what I not like to see is, yes, right. We would not like to see these type of policies at the central government level, especially added on after what the states are doing as well, because that means that the consolidated deficit then just remains very elevated. Or the other way to put it is that there are some quarters which also say that the government should just abandon fiscal deficit consolidation path. I think anything on those lines would not be great news, because that will imply that you're sort of endangering macro stability, which has been a very important aspect for the overall stability from a markets or a growth perspective as well, because that implies that inflation has been well behaved, current account deficit has been well behaved, and that also gives more degrees of freedom for, like, say, the monetary policy to focus on the domestic growth inflation dynamics. So I think in that context, the fiscal deficit consolidation path should be retained, should not be abandoned. That should be one. We would not like to see that. And second, the spending mix should remain biased towards capex than revenue expenditure.
Thank you so much, Upasna, for this wonderful exposition on what India's balance sheet could look post February 2nd. Thank you so much for your time, and we look forward to welcoming you again post the document is read. Thank you so much for your time.
Thank you.
That, ladies and gentlemen, was Upasna Chatra, the Chief Economist at Morgan Stanley India. I hope the conversation was really fruitful to you, as it was for me. Please continue watching Business Today television. On the other side of this break is Managing Editor Sitharaman.
A never-before-witnessed bloodbath shook tech heavyweights around the globe on Monday. The rout started in the US